Hey everyone, welcome back to the show. How many of you guys watch this Grain Markets and Stuff channel? Pretty good channel. He does a daily YouTube video and he's pushing for subscriptions to, I think it used to be called Standard Grain. The host of the show's name's Joe Vacalic, something like that. And he has a lot of neat information on his show, but when it comes to really forecasting and being able to forecast and as to why, that's where I become frustrated with the show or the things that turn the gears to make something happen in a forecast. That's where I don't believe he's very accurate, and that's where you come to this show. And I'll explain why. But yesterday, the FOMC decided to cut their December federal funds rate by a quarter point. Today is 12/11, and we're going to watch the 12/11 show here and see what Joe says.
Rates yesterday. I'm going to start there.
Yep, so the Fed lowered interest rates by a quarter of a percentage point, bringing its benchmark federal funds rate to a range of 3.5% to 3.75%, the lowest level since September of 2022. Despite the decision, 3 members of the Federal Open Market Committee dissented, the highest number of objections since September 2019. Fed Chair Jerome Powell said the cut should help to stabilize the labor market while allowing inflation to continue trending toward the Fed's 2% target. In its updated economic forecast, the Fed projects just one rate cut in 2026 and another in 2027.
Okay, let's look at interest rates. So the Fed cut our new effective target range for the overnight Fed borrowing rate is 3.5 to 3.75 percentage points. During this cycle, during that rate hike cycle, which was meant to tame inflation, we peaked just above 5%. So they're cutting rates. The inflation statistics are still too hot. At 3% CPI, we're still a full percentage point above the Fed's 2% target. Yet the Fed has what they call a dual mandate. The mandate is they focus on 2 things. They care about the labor market and they care about price stability or inflation. And in this instance, they're cutting rates because they're concerned about the labor market, and they believe for some reason that cutting rates is going to help the inflation situation, I guess, which is kind of a question mark to me. Here's another thing that you should consider as it relates to rates and inflation. So Jerome Powell's term ends in May of 2026. Trump is going to appoint, probably in the first quarter of 26, he's going to appoint a new Fed chair. And one of the prerequisites for this new Fed chair, Trump has said in so many words, is that he cuts rates and it makes interest rates lower and lower and lower, which could, I think, result in additional inflation. And as it relates to you guys, you corn growers, soybean growers, wheat growers, there has been inarguably a relationship between inflation and grain prices, especially in your post-COVID era. I don't think that there's any coincidence here. I don't think this chart is a coincidence that CPI peaked along with corn, soybean, and wheat prices in 2022, and that they've kind of declined together. Of course, in a vacuum, corn prices, soybean prices, they've got their own fundamentals. They certainly do, and the fundamentals aren't great right now. But if you were to ever return to a situation where you saw like a revisit of the COVID type inflation, I don't know if that's possible or not, but if they cut rates when it's not really necessary, at least in terms of inflation statistics, to cut rates, it's a risk that you run. Some people think that stagflation is a risk. This is a quote from Wednesday's Fed statement. Job gains have slowed this year, and the unemployment rate has edged up through September. More recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. So some economists believe that stagflation is a real risk given persistent inflation and a weakening job market. Stagflation basically is when inflation remains high, things remain expensive, but the economy's weak, people can't find jobs. It's like the most problematic scenario you could run into in terms of the economy. I hope we're not headed in that direction. I have mixed feelings about the rate cuts. I know they're a good thing for some of you guys who you borrow a lot of money, you're looking to buy a house, whatever. Rate cuts sound good, but there's a price to pay sometimes for this sort of thing. So let me know what you guys think about the rate cuts. I do think a return to like a real severe inflation situation would be a positive for grain prices, but it would also probably jack up your inputs again. So I don't know, maybe be careful what you wish for, but something to consider.
Okay, Joe, since you asked for a what do you think, I'll tell you what I think. I think you're an idiot. I think you don't have a clue how inflation works whatsoever, like 99% of the other people on the internet. So let's explain how inflation works. Well, first thing Joe doesn't understand is that the Fed uses something called the Phillips curve. The reason they use the Phillips curve is because they use Keynesian belief theory. The Keynesians believe that the more money a person makes, that means they can spend more. And if you spend more with the same quantity of goods, that drives up demand, meaning driving up inflation. So they like everything to be stable. Now, when you follow the Phillips curve, you basically follow the unemployment scale. So if people are not employed, then that's the priority. The inflation mandates, and by the way, the 2014, I think 13 or 14 is when they adopted the 2%, actually made it a mandate. And prior to that, it was just a suggested guideline. But they only really focused on inflation. And when we're on the topic of inflation and on the topic of unemployment, you have to remember that the Fed really only follows the U3 index, which is what's called headline inflation. And that's the new inflation. The older inflation guideline would be more like the U6 index. And the U6, basically adds everybody that's falling off of unemployment or whatever, it adds it to the calculations. And if you look, you got a chart here, 7.5% unemployment. It would be more realistic. So they should be dropping rates like crazy, and they're not, but they're trying to shore up that dollar, and I'll explain why. This is a chart of how an economy works. You have 4 quadrants, and then you have directional arrows with each arrow, being in a quadrant. So if you have rising inflation, but you also have slowing growth, you have stagflation. If you have rising inflation and you have accelerating growth, you have an inflationary boom. If you have slowing growth and slowing inflation, you have a deflationary bust. Accelerating growth, disinflationary boom. So this would explain what's going on and allow you to map a direction of where we're headed. And there's only 2 quadrants that corn or soybeans will do well in: stagflation or inflationary boom. And we'll come back to what causes those things to happen. Now, where we were in, say, 2021, after 2020, when they started printing a lot of money, you had a lot of easing and you had a shortage. So you had rising inflation, but growth was accelerating because people were out spending money. So you had inflationary boom period and commodities soared. Then commodities or inflation, when the Fed began tightening, you didn't really see a huge slowing growth. Yes, it slowed down, but inflation started sliding. Growth did kind of slide, so I would say that we hovered somewhere between disinflationary boom and more towards the stagflation. So somewhere right in about here. And that's kind of a neutral position, and where we'll be going next, we can talk about through the rest of the video. This is macrotrends.net. Corn price is 1959 to 2025. And for some reason, their chart has a big spike here. They need to correct their chart anyway. The chart actually ends about right in here. For some reason, there's like a $15 or $16 $450 spike on corn. For some reason, that's totally wrong. Anyway, so you go down here and you look at the actual corn chart minus their mistake here, and you look at this corn chart, and I've preached this on multiple videos. If you guys haven't followed along, multiple videos. The only time that corn really rises, you can see it's just sideways as can be. Here's the 1971 currency devaluation, sideways as can be. 2008 currency devaluation, sideways as can be. And I assumed that there would be another currency devaluation, after COVID, but that didn't happen, obviously, because they tightened their belts so much. Down here's the CPI inflation chart, and you can see it starts at 2017, pretty much just flat, and we went into our little recession there in 2020, and obviously started rising rapidly, and then right around 2022 we began a big descent. But what caused this? This is a rig count chart on the EIA website. Check it out for yourself, and you can see right around the time that Donald Trump was elected in his first term that the oil rigs around 18 really started to begin declining in numbers. And you can see here around 18 how they had peaked and how they very rapidly started declining. And then you had the COVID time era right in here where they really declined. And then they turned around and they started to rise again around 2022. You can also see under crude oil production in the United States how we were rising, right around 18 rising. Then around 2020, even before the pandemic, we actually started into a decline factor before the pandemic and really declined through the pandemic, and a huge decline. And then around 2022, we started rising again. Now, if anybody knows how to use their Google search bar, which is debatable based on the crowd that's on the internet, but if you use your Google search bar and just plug in 2018 oil crash, you're going to get just article after article about oil in crash. I mean, there's just 2018 oil crash articles are everywhere. It was all over the internet. Now let's take a look at the chart of crude oil prices, and as we rose, and then here comes the Donald Trump's first term right about in here, and look at the price ended up going way down. Of course, then there's the pandemic when it absolutely collapsed. Then we turned around, we rose from there. Now when you're Googling those 2018 oil crashes, you should be Googling the Iranian sanctions brought on by Trump, which then he turned around, lied, and granted everybody waivers. In other words, Donald Trump flooded the market. And you can even read that on Google AI. The Trump administration in 18 reimposition of sanctions on Iranian oil exports intended to cut them to zero, initially tightened the market, but the oil crash later that year in late 18 resulted in a combination of factors from the U.S. granting temporary waivers on some Iranian import. Well, I think there was about 8 different countries got granted waivers. So what happens when you flood an oil market? It'd just be like flooding the corn market. Inevitably, you have to basically try to quantity your way out. And that's kind of like guys were supposedly able to do in the year 2025 with their corn, was they were able to bushel their way out, quantity their way out. I don't have any money per unit, so I'm going to just try to make up a larger volume of units. Now, after all of the Donald Trump screw-ups prior to the pandemic on the oil market, flooded it with foreign oil, which inevitably crushed refining capacity, crushed domestic producers, indebted them. His solution at the pandemic when oil went negative was to come out with what was called the OPEC 2020 Plus deal, which was to cut almost 10 million barrels of oil per day out of the global market. Now, you have to remember, the United States was only producing about 11.5, 12 million barrels of oil total at that time. That's like the United States, essentially. Almost like the United States just going bloop, offline. No more oil production. Now, what do you think that that's going to do to the price of oil? Now, that was a 2-year deal with a transitional period and ended in 2022. Now, let's take a look at the CPI. So right about here's the pandemic. Then the country opens wide open under a 10 million barrel per day cut. Severe shortage. The key word here is shortage. What happened? Straight up. And look, right around 2022, when that OPEC 2020 deal ended, and if you go back to that chart of crude oil production, and you look at rig counts, and it all started picking back up again because the price went up so much that they started drilling again. So, shortage, starting to supply back up. Price comes down. That's also about the time that Biden dumped a whole bunch of the strategic reserve on the market. Now, most people, and by that I mean the internet, thinks that somehow it's the money supply or printing money is inflationary. Well, it's really not. It leads to a type of inflation, or can, depending upon the use of the money. But really, when you see large quantities of inflation, big time ass inflation like we saw, it's generally speaking commodity driven shortages. Now, what also happened in grain during that time? Well, you had the 2019 flood outs, about 20 million acres. You had 2020 derechos. You had the Black Sea deal, so you had 2 years of shortages. Plus, the Black Sea deal also went in and we had a large price increase in the CPI. And not to mention all the other shortages you had just because they shut the entire country down.
A lot of it does come in from Canada, and so we'll end up putting very severe tariffs on that if we have to, because that's the way you want to bolster here, and we can do it here. We can all do that here, but I would say what you do, you put very severe tariffs on from coming into other countries. You'll be making your own fertilizer.
That was Donald Trump talking about potentially implementing really high rate tariffs on fertilizer coming in out of Canada. Now, bear in mind, they just announced an aid package to farmers. So how do they know that we're in trouble, but then want to immediately slam on the brakes on fertilizer? At the same time, it could take years to get a new fertilizer facility open. I mean, it just seems to me like we're going to do a crash landing first and clean up the pieces later. Now, this is a Fed chart here, Federal Reserve Bank, and this is the M2 money supply, which is basically your total money created out there. And you can see how it's just increased, and you can see how around the pandemic it shot way up, and it's actually knocking off a record now. But ironically, if you go back to that CPI chart, CPI peaked, and it's actually been down ever since. But the money supplies went up. So it pretty much proves, as well as Donald Trump's first term, as the money supply was increasing and inflation was trending down, it pretty much proves that the money supply is not directly inflationary. Now, it could be seeding things for an inflationary period later, like right in here where we saw these shortages take place, and then that area here occurred, which then we had the shortages. So the inflation is too much money chasing too few things. Keyword in shortage, at the same time of a federal easing policy. Well, right now we technically don't have a federal easing policy. Technically right now we have a tightening policy, restrictive, meaning that it costs more to borrow money than that most things bring, like in inflationary terms. So if inflation is 3% and it costs you 5% to borrow money, that's a restrictive mode. Now, if it cost you 2% to borrow money and you had a growth like on a stock or something of 5%, that's a real rate of return, positive real rate of return. That's when they want you to borrow money. Now, we have a very high M2 right now, a record, and we have inflation trending down. Now, Joe, in his show, stated he didn't know if we would see another round of inflation like we saw during the pandemic, and there's your first Trump years, and here's what we saw with the inflation. And then, that's what I just explained. This is pretty much your OPEC 2020 deal plus your grain shortages. And then it obviously came back down in 2022 when the floodgates got reopened, So shortage, monetized shortages, monetized tightening, no shortages. And it forms a mountain. It's a boom and a bust. You kind of notice how we had this sideways band here, and then you have a sideways band here. Now, when you look at like that oil production out here in the crude oil over the years, so you go back around the mid-80s and you look till about 2010, and by the way, about 2010, that was a really good time in farming. You had that cheap dollar, but look at the oil did long-term. Production just went long-term down. And look what the price was doing all that time. It was doing long-term up. So less production equals more price, more production equals less price. The Fed calls quantitative tightening, meaning they call it balance sheet runoff, and what it means is they basically sell their treasuries. Now, the Federal Reserve can only buy things on the open market that are basically like mortgage-backed securities or treasuries. And the treasuries are where the government gets their money. The government gets their money two ways. They either issue debt or they tax it. And they issue treasuries, so it's just debt, and they can monetize it. And then the Federal Reserve has been buying a lot of those treasuries. So the Federal Reserve is a central bank, and they buy treasuries. The collateral is the strength of the country because it's no longer gold. Anyway, the Fed has announced that they're going to buy about $45 billion a month or so, and I heard upwards of 60 at some point. But they're going to start buying treasuries again. But they might be selling mortgage-backed securities. So what that basically means is they're going to shore up the government because the government's broke, has no money, and nobody's buying their debt. They're going to shore up the government. At the same time, they're going to sell off their mortgage-backed securities. And the housing market's really not that great a shape right now. So they start selling mortgage-backed securities, which, by the way, farmland's included in those. After the late 80s, it was included in those. So we could see a housing and farmland crash or decline. At the same time, the government will be getting some money and perhaps for the next whatever happens. If you've been following these series of videos, you'll have noted in the other videos that I said long-term corn in its new trading band was $3 to $8, was an average of around $4.30, $4.35, $4.25, somewhere in there is a little pretty narrow trading band. So just figure $4.30. Now, if you look at this time period, and we were averaging lower than that, but we came out of a spike. Come out of a spike here, higher than that. So I think we're going to see another trading band like this. This kind of a long, low, longer degree angles, and you strike an average through it, then you strike an average through this, and through the whole damn chart, and you're going to be back to about your 430 average. In other words, out of, since 08, multiple years here, I mean, in a couple of years, you're talking 20 years at the exact same priced corn. Then we wonder why there's a farm crisis going on. So if you're a corn farmer, I think that your cash price is going to be somewhere in the maybe $3.65 cash to maybe tops of $4.95. If you're really lucky, you might bounce $5 cash, but right in that range, and then you average that out about $4.35. If you guys have been following the wind turbine debate, Donald Trump has cut a lot of tax credits for wind turbines. That comes at a time where we're going to see majorly increasing demand from things like data centers in places like Iowa. You have seen pretty stable prices on your electric bill because of all the additional wind turbines that went in. And before somebody says nuclear, yeah, nuclear is a good source of energy. It just takes time to set up those plants. They're not instant. Wind turbines are deployed much faster. So if wind turbines are deployed much faster, but now there's not the incentive or as much incentive to buy them or build them, and you have a major increase in demand. Now, I've read 60 to 70 gigawatts of energy required for these data centers coming online. At the same time, Donald Trump's cutting 80 gigawatts of wind turbine power, and that's at a time where there's really no other energy being produced anywhere. There's no other plants that are really rapidly expanding or can be built that quickly. So I think that you're going to run into an energy shortage. And where they're going to turn to will be more natural gas at a time where Donald Trump is wanting to double exports. So you saw, the COVID issues with, and this is natural gas prices, but you saw the COVID issues, and look what's happened. They bottomed out, but they've actually been increasing, longer term increasing, to in the mid-5s here recently. Well, natural gas, there's your anhydrous ammonia, and then anhydrous ammonia will lead other forms of nitrogen prices. So you have a corn market in a sideways tranche with maybe a little longer-term decline, and you have Donald Trump increasing your fertilizer nitrogen prices, and just your power bill at home and to operate your farm. And at the same time, now he's threatening to shut off potash. So you're going to have increasing bills at the same time of a sideways to potentially down corn market. And as far as soybeans, I don't personally see anything that says they're going to skyrocket in price. And the quote-unquote China deal that Trump has offered, I don't think is going to be anything of great value, and it was actually lower or lesser quantities than years prior. So you have a lot of money being printed. The M2, we've obviously shown, is at record highs. The dollar index is rising as long as it's under a restrictive rate. And I think they're going to stay restrictive. I think they're going to remain hawkish. They just don't show signs that they're going to go into a very easing policy unless the labor market completely crashes. And the labor market completely crashes, that's a major slowing growth. There comes that Keynesian belief theory. And those Keynesians believe that when labor market crashes, that they'll go ahead and they will go back into an easing policy. So if the labor market totally crashes, be prepared for them to drop rates very rapidly. Anyway, if you look at these quadrants, you do have slowing growth right now, and our inflation is trending downward. That pretty much leads you to a recession. The reason I say that, I mean, you look at the housing market's in trouble, auto repossessions are at record high, credit card debt's at record high, people are eating minimal, I mean they're living paycheck to paycheck, they're not out there spending money, they're not buying things. You're seeing a lot of bankruptcies showing up in the news every day. That is not anything to do with the inflationary time periods, and unless you're in the inflationary time periods, you're probably not going to see a rising corn or soybeans. So as far as Joe, with his theory that the M2 directly leads from rate cuts will directly lead to rising inflation, he's 100% wrong. Now, we are technically in a K-shaped economic recovery, which means that the 1% that has the most assets is growing and doing well, while the rest of the bottom 99% suffers, and that's largely due to that Fed's policy of slowing the inflation down but accelerating the growth, and that goes back to a rate of return where the stock market returns about 10%, and then you can borrow money for around 6%. So it's restrictive for everybody else, unless you're for Wall Street, which is how they get to saying the Fed's got my back. So does that add to Joe's show? Stagflationary risk potential. That's not rising inflation, though. That's just like lingering sticky inflation, so I really don't think Joe has it figured out. Hopefully if Joe watches this, that's how it works. And if you have more questions, add to the video, because I like to just continue this series and just keep going on down the list, explaining it to you guys as it goes. And a few of you guys are really interested in it. Appreciate the open mind, and thanks for watching. And before I close out the video, I did want to add that probably many of you have been watching and seeing what's going on with the Ukraine-Russia war, as well as the oil glut sitting in tankers out in the ocean with sanctions on the oil where there's no buyers. So why do you think Donald Trump, with declining poll numbers, wants to settle that war so badly? Very likely because he wants to flood the living piss out of the oil market by removing those Russian sanctions. Much like he wants to do with the beef industry. Who cares who he harms? Domestically, he's only worried about cheap shit for them winning the midterms. And as to why the Fed has the stock market's back, is also partly to do with tax code passed under Donald Trump. To you yet? See, Donald Trump doesn't care about anybody. He only cares about certain wealthy and elite, while the rest of us are just a bunch of cockroaches. As far as the cattle industry, the reason it's gone to hell is because for too many years nobody made any money, and you combine that with droughts and high feed costs and everything else. These old farmers are just saying, fuck this, I'm done, which caused a shortage. Then the market goes up, demand's been pretty good, but to crack this, Donald Trump would prefer to flood with the imported markets. After all, nothing says America first like a whole bunch of imports. That includes many of the 30,000 or more gas and oil industry jobs that have already been lost. So what's likely to happen when they start flooding beef is more farmers will say, fuck this, I'm out, and then you'll be even more reliant upon imports. At the same time, supply won't change much, because as one person exits, another enters. And depending what this crazy and very highly unpredictable president does, and as a disclaimer to this entire show, it becomes a little hard to forecast when you have a guy who wakes up and mood swing dependent can rock entire markets. We've seen that twice this year just on True Social posts about soybean. But if he is successful and floods the living hell out of the oil market and destroys an already depressed oil market even further, yeah, eventually you'll have a whiplash effect. But for the short term, when the oil market's flooded, as far as Joe Viculak, or Vickle Dick, whatever the hell his name is, when's the last time you saw high dollar corn with cheap oil?